Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you off course. I hope to make it actionable, understandable, and clear. Feeling a little better over here. Therefore, what a show. Thank you for the well wishes, listener community. When the podcast didn't drop, yes. Last week, some of you noticed. Thank you for that. I had the flu, type B. It was not fun. I want to try to keep your temperature low, your health high. I need a different moniker because I could have cared less about cost low, investing simple, and time horizon long in that moment. All I cared about was stay hydrated, rest up. So I'm feeling better, a little fatigued, but the show goes on. I knew we couldn't do 2 weeks back to back with no show. Some of you guys would have been speculating on securities, trying to get rich quick. I couldn't have that happen. So we've got a show for you. We're going to be looking at platform fees. Fidelity announces they're going to start increasing the number of fees that they have if you buy a certain exchange trade fund. We then look at a famous hedge funder, Mr. Paul Tudor Jones, and his warnings on the S&P 500. And then in closing, it's a little bit of a Robert's Corner here, where we're going to look at what do you do when someone offers you a private deal? And this is just one facet of it, but what do you do? What are some strategies you can have to help better understand what offer has been made to you through this private deal? But let's start at the top. Fidelity and platform fees. Well, let's talk about platform, shall we? So, as you may know, if you want to be a self-directed investor in 2026, and I hope you do, I know it's not for everybody, but I hope you aspire to that, there are some major brokerage platforms you can choose. You can choose Charles Schwab, you can choose Fidelity, you can choose Vanguard. There are other smaller ones, but those are some of the main ones. And each of those platforms has pros and cons. It is still my contention that Vanguard, for most people, offers the most compelling offering as a platform, but all are permissible and can be worked with just fine. What crossed my news feed that I know bears import for you is that Fidelity, oh yes, Fidelity, they are now increasing the number of exchange trade funds that are going to be charged a fee if you purchase them. Now, rest assured, I checked the list. It's now up to 127 of these ETFs that if you buy one of these ETFs, it's $100 per time you purchase it. And the list right now are very specific ETFs. This is not your VTIs, your VOOs, your SPYs, these broad-based market cap indexes. That they're not doing that yet. But the reason why Fidelity has decided to do this, of course, money. As a wise King Solomon said, bread is good for laughter, wine makes life merry, and money is the answer to everything. They have decided that if these companies don't pay their platform fees, so Fidelity has a pay-to-play, hey, if we're going to let you buy these ETFs on our platform, your company better pay us. It's part of how they make money. We as the consumer have to be sharp here, and the lesson for us is these platforms are not static, all of them. So whether it's Fidelity, Schwab, Vanguard, I've seen the rules change on every single one of these. And the game that is being played for the self-directed investor is we want to use these platforms in as cost-effective and efficient a manner to further our aim as investors. The platforms, don't always think that way. They are not you. Your interests are not perfectly aligned. Vanguard's used to be more aligned than they are today. They're still structurally aligned, but it's gotten a little noisy over there at Vanguard. They're now pushing products and higher price products than they have in the past, but it's still better than most. But just beware, Fidelity, Schwab, if you go over there, and Vanguard, if you go over there and you have sufficient resource, be be assured you will be cross-sold at some point and be pitched some product at some point. Now, this relates to the ETF game just because these platforms' rules are changing. So while you may just say, you know what, I'm all in on Schwab, it's good enough for me, I'm just going to park my ship in this harbor and feel safe forevermore, you can't do it. You got to have a bit of vigilance, and it doesn't mean every day and it doesn't mean every month, but maybe every other year or so, you've got to at least look up and make sure, are these folks giving me a fair look? Is this still the best platform for me? For now, it's fine. You just got to be mindful you don't take the bait when they offer you an expensive product, which they will do. But just beware. As Fidelity shows their hand here and you realize, this is not some level playing field I'm entering when I enter Fidelity. I'm entering a coliseum where there is a fight where they want your money and you want your money and your interests are not aligned. Now let's talk stock market. It has been a surprise to me. With all the news, and you know the news, all news. In the last year, what do you think the overall U.S. stock market is up? Last 365 days. Think about it. I don't want, think about all the news, all the, we got troubles here and troubles there and stop and start economies, and you're up 29%. In the last year, the U.S. stock market, you're up 29%. What do you think you are internationally? International stock market. Everything but the U.S. What do you think you are for the last year? You're up 29%. Would you think that? I wouldn't. With all the news, I'd think, oh yeah, man, be lucky to be trading flat over year. No. Another reminder. Don't listen to the naysayers. Well, I'm going to give you a naysayer. Maybe he's right, maybe he's wrong. This is Mr. Paul Tudor Jones, net worth of $8 billion, 71 years old, famous hedge funder. He has a warning for you, despite what I believe is time-tested strategy of keeping your time horizon long. He says this on buying the S&P 500 right now. He says if you buy the S&P at this current valuation, the 10-year forward returns are negative. When you buy with the S&P PE, price to earnings ratio of 22, that's what history shows. Now, this gentleman, to bolster his case, he called the 1987 crash. This was a big precipitous crash in 87 before it happened. He says this, the stock market's really high and it's going to be really hard to make money from here. Are we scared, listener? He's worth $8 billion. He's got, quite the track record of being able to predict things. Predicted the big crash in 87. Well, what's the counterpoint? Something to remember with markets, and it's hard to do when someone who's got a track record of success, very wealthy, issues proclamations from on high, and you kind of start to think to yourself, well, who am I? What was me, a little investor ABC? What am I going to do to stand up to the preeminence and wisdom of Paul Tudor Jones? Well, let's go back to the basics now. First principles. When he says, hey, the stock market at these levels always returns, he is talking about reversion to the mean. It's his belief that the earnings multiple, how much people pay per dollar of earnings, it eventually will go back to the way it is normally traded. That may or may not happen. That is quite an assumption. I think it's not an unfounded assumption, but that's quite an assumption to make. And you've got to ask yourself, the stock market is disagreeing with Mr. Tudor Jones. And how do we know the stock market disagrees with him? Because transactions are going off of these prices. What does a market do? It brings together buyers and sellers at a mutually agreed upon price. That's what the market does. It finds price equilibrium and people trade. So there are buyers right now, lots of them, billions and billions and billions of dollars, institutions who see Paul Tudor Jones' comment and are not listening to it. Now, there are sellers who may very well be listening to Mr. Paul Tudor Jones. That's what makes a market. I have a much higher degree of confidence that the market is absorbing all the relevant information and all the important variables than I am one man. Now, that one man may be right. He may be wrong. But what I've noticed over the years, and you've probably heard it on this podcast, a lot of predictions. People have no problem issuing a warning about the elevated stock market levels that we're experiencing and the negative returns that you could experience over the next decade. I would not recommend trying to time anything. Even if this is the 1999 moment, 2000 moment, even if this is the 2007 moment, even if this is a 1929 moment, that would be the most harrowing of them all. The idea that you or I could predict that moment, no. And then the counterpoint, so what are all these buyers doing then? If it's so obvious, if mean reversion is such a self-evident thing, well, article this week, the Wall Street Journal, headline, Corporate America is minting money, and not just in tech and finance. Subheadline, profits grow for many companies in the face of war, rising oil prices, inflation. It's extremely polarized. Well, here you go. And this article walks through some of the S&P 500 companies and what's been happening. And wouldn't you know it? Let me read you this quote. Earnings growth has been exceptional, said Parag That, an equity strategist for Deutsche Bank. We're seeing the broadening of earnings growth beyond just tech and financial. Oh, so maybe these buyers see something they like, and that is what's making the market. So they talk about profit margins in the S&P 500 and that they're improving. So there's real expansion, rising earnings. Turns out these are organic rising earnings, not just share buybacks. So earnings growth, it's expected to reach 48% for tech companies. That seemed way too high, but that's what the article says. And so that would incent buyers at this level, counter to Mr. Paul Tudor Jones. So with any market, and this is just the way I've always experienced it, bears, people that anticipate the market to fall soon, they sound smart. Whenever someone tells you there's a stock market crash coming, it sounds like good advice. Whereas if someone gives you the encouragement to invest and be happy about the future and good things are to come, they sound Pollyanna and a little foolish. It's just our wiring. People sound more intelligent if they are warning you about the perils that are to come. If you were just to simply close your eyes and own the market, be willing to do so. Be willing to close your eyes and own the market. There's not a better strategy out there. And if you elect to get on, it's Paul Tudor Jones today, it'll be someone else tomorrow. I have seen people that eventually go down this road. They decide they have a couple really intelligent folks they're going to follow, and that's who they're going to, link their wagon to. They basically just stay in cash. They're in cash. They've been in cash the last 10 years. They're waiting. They're still waiting for it. They're waiting for that pullback. And then they read an article or they read Paul Tudor Jones's pronouncement about the price to earnings ratio, and they feel good at night, but their results are terrible. So don't do that. Don't do that. Be optimistic. Be willing to experience the good and the bad. And in closing, what do you do when someone presents a private deal to you? This may never happen to you, but if it does, it's good to be prepared. And I'll stick with a common private deal, a real estate deal, or an energy, oil and gas deal. What do you do? And I will help folks think through these deals. I won't promote them myself, but as folks receive these deals, I'll help them think through them. Well, we won't walk through all the things that I recommend doing, but one thing that I've in the past week or two anchored to more is this idea of opportunity cost. Well, let's say someone is pitching you a land deal. You're just going to buy raw land in their fund. Is there a way for you, listener, to do the exact same things they're purporting to do in their fund? Can you do it at a low cost in a publicly traded vehicle? Now, this doesn't mean you can't do the private deal, but you at least want to know, is what I'm being promoted right now, is it really proprietary? Is it unique? Is it something I can only get in this private setting, this private deal structure? Because, as you know, the more we increase the complexity of investing, the less likely it is it will do well. Doesn't mean it can't do well, but there's more fail points that can occur. So one data point I thought was interesting is I was doing some research on, all right, well, what if you just wanted to own land, but you don't want to mess with a real estate lawyer, you don't want to do it yourself, you don't want to go through the fund. Are there other ways you can do it that are easy? And wouldn't you know it, our friends in the artificial intelligence world, if you just start talking to your Gemini agent or ChatGPT, they got good ideas. One of these ideas that came across was a company called Weyerhaeuser Company. It's one of the largest landowners in the United States. Ticker symbol WY. Of course, I'm not recommending you buy this at all, but it's an important discipline to have, is to realize how many options you have. It is a great temptation when you're in the hot seat and you're being presented a deal to think in that moment, hey, this is kind of my only shot at asset class XYZ or returns or whatever. It's almost never the case. There's almost always a way for you to access what's being promoted to you in a low-cost, simple way that gives you control. Because in a lot of these private structures, you do not have control. You kind of are getting on a 7, 8, 10-year train, hoping it does well. But this company, Weyerhaeuser Company, one of the largest owners of land, in particular timberland in the United States. So what I found interesting is they've got 10.4 million acres. 10.4 million acres, a market cap. So the company's worth about $18 billion. So you back into it, it's like, oh, that's only like $1,700 an acre is what you're paying for it. Now then I'm talking to my AI friend. I'm saying, all right, well, what is that land? If I had to buy that land privately, would I pay more than that, less than that? No. There's a discount. You get a discount for buying this publicly traded vehicle. There are reasons for the discount, but they talk about recent sales Weyerhaeuser had of land. They sold land in Oregon for $6,700 an acre. They sold land in Alabama for $2,500 an acre. Well, if you buy it on the stock market, you're only paying $1,700 an acre. So you can buy land with a ticker symbol cheaper than you could just going out with a land broker and a real estate attorney. That was interesting to me. It doesn't mean you don't buy private land. It doesn't mean you don't do the fund. It just should help calm us down a little bit to think, I might be able to do some of this stuff myself. Now, there's a reason for this discount. As you know, I think the market is breathtakingly efficient, and I'm not a believer in a bunch of secrets that can be used for our advantage. So what's happening? Well, this company owns a bunch of wood mills, and they're really just, the valuation is on their earnings, in a sense, and the dividends they can pay, not on their liquidation value. So it'll trade at this discount potentially forever. So there would be no, oh, gee whiz, aren't we smart? We'll buy all this land via ticker symbol, and then one day they'll sell it all. No, that's not the plan. But always be willing to find, hey, is there a simpler way I can achieve my investing results than what I'm being presented to right now? And ultimately, now the journey I go on is, oh, great. If you look at this stock, I bet you won't be that excited. In the last 10 years, if you bought the Weyerhaeuser Company, you're down 22%. Can you imagine? And it's almost traded flat from 1984 to present. Can you imagine that? 1984 to present, you're basically dead money. But you're buying acreage cheaper than it would be on the private market. Oh dear, how excited are we? So ultimately you go back to, okay, just buy an index fund. But these little exercises can sometimes keep us out of trouble when a very enticing private deal comes our way. So let's stick to the basics. Let's remember what got us here, which is keeping our costs low, investing simple, and time horizon long, because that is what's going to give us the best shot on our investing journey. Until next week.